S&P Global Commodity Insights has released its annual oil sands production forecast, and I'm going to talk to Kevin Birn, the economist who's the chief analyst for Canadian oil markets for S&P. So welcome to the interview, Kevin.
Good to be here, Markham.
Well, this is really interesting because, you and I do this every year, and sometimes we do it multiple times in a year. And this one kind of surprised me, to be honest, because you're forecasting a 500,000 barrel a day increase out to 2030. That gets the industry up to 3.7 million barrels a day and 140,000 more than the last time we did this. What changed in between last year and this year?
Well, it was 365 days. I'll not be too cheeky with you. I think the big thing is, we see the industry kind of going through an evolution. And we hinted at this at the release last year. We saw the potential upside risk due to greater optimizations than we anticipated at that point in time. And that is indeed what we have seen happen. Another year of relatively higher oil prices compared to the past period of half decade has strengthened their balance sheets. It's also given them more confidence to start focusing a little bit more on the long term when they talk about their guidance at their shareholder meetings. And that's what we're seeing kind of surface. The industry is talking more about how they plan to manage their facilities over a longer period of time. And that's providing us as analysts a better insight about where these facilities may go. And what is occurring is they're talking more about leveraging the land they have and the facilities and the operations that are existing and in place to maximize them, to figure out ways to squeeze them to produce as much product as possible. Now, this is a cost play as much as people tend to look at the upstream and they measure everything in volume, but this is a cost and efficiency play for them, right? Cost, there is the fixed cost, but there's variable cost, but there's also the ability to manage your cost per unit by putting more units into the market, right? And so you can maximize or minimize your cost per unit of output by maximizing your output. And then often these optimizations will have cost synergies out and out on their own right as well.
Now, in the last year or two, in the investor presentations that I've been reading, the oil sands companies are talking about getting their break even in, and they express that in West Texas Intermediate costs per barrel. And they've been talking about getting it down from where it is now, low 30s to maybe 45 at the dollars per barrel at the outside, down to like mid 20s to low 30s. Is this part of that strategy?
I'd say it's all part and parcel. It is tied up. The oil sands cost, not to go into, you and I have had these conversations on oil sands cost too. A lot of them, the cost structure is influenced by the market environment. So there is the cost that they can manage in terms of how much natural gas they use to produce a barrel of oil and stuff like that. But there is the fact that they buy these products from the open commodity markets as well. And so in the higher price environment we're seeing with higher oil prices and higher natural gas prices than we have seen in the past, that's also putting some upward pressure on the cost structure. So they're trying to minimize the cost they can by becoming more efficient in how they use the things. We've talked about this as well in the past. We have seen the industry use those molecules of natural gas that they need to generate heat more efficiently, and that's driven carbon intensity reductions, but it also drives a per unit cost reduction from them as well. But they are dealing with the realities of the market they're in as well, inflationary pressures from labor and elsewhere, but also inflationary pressures in their cost structure from the environment we're in and having to buy more expensive gas or the price of condensate that the fellows that have to blend have to purchase as well.
Before we get into exactly how they're how they're doing optimization, maybe we can talk about the market, because as you and I have discussed many times, the global oil heavy crude oil market is about 10.5 million barrels a day. The Canadian producers sell into the American market, which is about 5.5 million barrels a day. And it seems it's been kind of disrupted lately because Mexico was talking about taking 600,000 barrels a day of heavy Mayan out of the market to process it domestically. And then there've been some, Venezuela's been a wild card for since 2016, 2017. So where is this 500,000 barrels a day going to go?
Okay, so most of the Canadian crude goes to the U.S. Midwest and the U.S. Gulf Coast, and it finds a home in heavy complex refineries. And that home, part of that has been, if you go back a little bit further, we saw a build out of U.S. heavy complex refining capacity to kind of meet some of the Canadian barrels in the Midwest. But in the Gulf Coast, that refinery infrastructure was built out to meet the Latin American crudes, which are more or less in decline. Now we have a little bit of resurgence from Venezuela and elsewhere, but the Canadian crudes have really moved into that Gulf Coast and taken that market share from the Latin American crudes. You can say that's because they've lost volume. You can also say the Canadian crudes have also pushed that off. We see Canadian crude continue to flow down to the Gulf Coast, increasing volumes. I expect we'll see record volumes this year as well, and that's where the most of the supply growth will come. But the other piece is the West Coast access. The completion of Trans Mountain Pipeline is really important for the Canadian basin. Not only just a purely volumetric thing, but it's a price effect as well. They need that infrastructure to clear the heavy barrels out of the market to allow the price to balance on pipeline transportation. Once in the Pacific Basin, that barrel on a vessel is free to flow to the highest price point globally. Now, when we talk volume, we think 500,000 barrels of export capacity is a big number, right? But in the grand scheme of thing, in a world that consumes 100 million barrels a day, it's just going to get blended away. Some of it will end up in California. Some of it might end up in Asia. There's heavy complex refinery capacity in California. There's certainly heavy complex refinery in Asia, China, and India, and elsewhere. So it'll probably just get blended away. So we see a lot of that volume going that way. And we do think the Western Canadian system will fill up with this kind of growth. We see the overall takeaway capacity out of the basin being full by the latter part of this decade. We don't think it will change. We don't think we'll overrun and we'll end up in a crude by rail and a weaker differential situation, but we do see a high level of utilization on the export capacity out of the basin over the longer term.
Now, let's talk about how the companies are going to optimize. There's a term here that I haven't run across before in your work: step out optimization projects. Can you describe those for us?
Sure, I can try. And the reason you haven't heard of it is we were trying to think about how to name these things. And so you have different types of optimization, right? The one that you've seen historically used the most in the industry is just debottlenecking. You have some sort of physical capacity restriction in your plant. If I just widen that out, I can get more units through that one tight point, and I'll get higher output as a whole. So that's one type, and certainly that's contributing to some of the production optimization we see. There is capacity that's installed that hasn't been fully ramped up. And then there's efficiencies you can do in ramping that up as well. That's a major driver of our production growth as well. The last one is this category we call step out optimizations. And you're right. We view this, the best example of this is through the last couple of years, we've seen the quote unquote Canadianization of the oil sands. The big oil sands players acquired people that were less interested in the assets. They gained scale in doing so, and largely have production facilities that exist. But the other thing they got is land that came with it. And so when you think about an operator, they may have a piece of land that they're producing oil on, and the land next to them isn't theirs, and the land next to them isn't theirs. But now they've acquired a lot of the land around themselves. And so now they're looking at that land going, you know, in terms of quality, the land I acquired just over here is a little bit better than I had it planned to go into to continue to maintain my facility, because they still have to drill wells to maintain the plant operational capacity, at least on the thermal side. And so, well, now I have better land over here than I thought I was going to do here. And if I go into the land over there, if it's better, it means it has higher saturation or more oil, or you can think about it, or I can produce it more efficiently because there's less problems with that reservoir. So that means if I build a steam pipe over there, I can probably produce more oil more efficiently for less energy in doing so. And a lot of these plants are water restricted. You think about the thermal plants, they're primarily a water treatment plant, and they're limited by their ability to generate steam. So again, water handling and the ability to separate the water from the oil. So if I can produce through a higher quality resource using less water per barrel, that probably means I can produce more oil for the same infrastructure. And that's kind of what step-up optimizations are. I've got new land, or I've rethought about how I can go into that land. I'm going to go and drill that well over there first, not over here, which was plan A and plan B. But that plan B is better than plan A, and I can grow incremental production because I can use the resources I have. If you're talking about steam, thermal project, I can use the steam more effectively to produce more oil using the same steam than I would have done if I went and used what I already had.
What about large-scale greenfield and brownfield projects? We've discussed this in the past, Kevin. Are these going to be a thing of the past?
We don't have any greenfields in our outlook. We do. There is a few people that have indicated interest in building some brownfields, and so that is a potential. But certainly the vast majority, if not all of our outlook is dominated by optimizations at this point in time.
What about the impact of those 500,000 barrels new barrels per day on the oil sands greenhouse gas emissions? You and I did an interview not that long ago about how the industry's emissions had risen from to 80 megatons a year currently, and it was going to go up to 85 by 2025. With the extra barrels now, are we going to see a higher number by between 2025 and 2027?
We don't really expect to see so. These projects are all operational efficiency driven, which come with often negligible kind of emission impacts. Again, if I use the example of that step out optimization name we came up with to try to name these projects, if I'm using my steam, the same volume of steam, more effectively, or in a resource that has the ability to produce more oil for that volume of steam going in, the generation of emissions which comes from the running of the boilers that produces steam is not changing. I'm just recovering more oil for the same amount. And so from an operational standpoint, what's happening is that's not necessarily going to change their absolute emissions profile, but it will change their carbon intensity, right? Because I'm getting more barrels per that volume of emissions or volume of steam in this case, right, being produced. And so I many of these projects we see as having a negligible effect on their overall emission profile. And I don't think we're in the course of looking at our emission forecast, of course. I'm not expecting any dramatic changes from the prior publication we put out last year.
Well, Kevin, thank you very much for this. Really appreciate it.
Very well. Thank you for having me again.